Hello, everyone, and welcome to the latest LPL Market Signals. Jeff Bookbinder, your host, with my friend and colleague, Jeffrey Roach. This, Jeffrey, is a special Dunkin' Donuts edition of Market Signals because we just figured out you and I are both drinking Dunkin' Donuts coffee. We are not paid sponsors by Dunkin' Donuts. I just thought that was very interesting because I'm in Boston, where that's what everybody drinks, and you are not. How about that?
We are not paid sponsors. So yeah, that's good disclosure on that one. But yes.
I don't expect my friends in the Charlotte area to be drinking Dunkin' like we are up here, but that's great. So we got a good show for you today. We got a lot to talk about. It's a real busy week this week in terms of economic data and economic events. Unfortunately, we don't have a positive week last week to talk about in terms of the market because we were down. So we'll recap last week. The energy sector was a winner, but certainly most of the S&P sectors were down. The LPL Research's investment committee upgraded the energy sector. So we'll talk about why we did that and why we think the energy sector is a good opportunity right now. Next, we'll do what I call a soft landing check-in. That, Jeff's going to be your area of expertise. We've got some charts on economic growth, economic surveys, inflation, et cetera, just to see where we're headed. And then, of course, as we always do, we'll preview the week ahead. So let's start with just a quick recap of last week. We have the market performance table here. S&P down about 1.3% for the week, so not a big drop, but we were down. The NASDAQ a little bit worse, and then the Russell 2000 small caps even worse than that. So it was certainly a risk-off week. You can see the risk-off week in the sector performance too, because while energy was up, you had industrials down the most, down almost 3%. You had technology down over 2%. Actually, a big reason why. It's really two reasons why. Apple and NVIDIA were both down about 6% last week. The Apple decline was certainly in part due to the news that Chinese government officials are banning use of iPhones. Markets thinking that maybe that restriction widens out and has a meaningful effect on Apple's business. So Apple was down on that news. This week is their big release event. So, maybe that stock will get turned around. But anyway, it was a down week last week. And I guess the international market's not really offering much relief because you had declines all across Europe. You had declines in most of Asia as well, although India, interestingly, a standout. You had the international headwind last week of the strong dollar, certainly, that made it tough for international markets to gain ground. And then just quickly, fixed income and commodities here. You had a fixed income week that was driven more by rates, and specifically higher rates, than any sort of credit assessment, because essentially every segment of the bond market did the same thing. It went down, whether it's treasuries or high yield or anything in between, all down about 30 basis points. And then on the industrial or on the commodity side, energy stood out just like it did on the equity side because you had oil higher last week. But look what commodities did outside of energy. You had declines in industrial metals, precious metals. Grains pretty flat, soft commodities down. And I think part of that is the strong dollar again, right? So a strong dollar weighing on international returns and on commodities. And anything you want to pull out of last week's market activity, Jeff, that kind of underscores the performance I just went through?
I think if you look at the energy side, so yeah, a little higher than 1% on the week, but you really need to shift your eyeballs a little bit over to the right, looking at that 3-month column. And it kind of tells you that part of this story has been in the last 3 months. There's been this, a stronger support for Q3 growing pretty strongly. The soft landing narrative, as you teased out actually just a few moments ago at the outset of the podcast. And as as the soft landing narrative kind of gains ground, perhaps, energy demand might be a little bit better than, say, what investors thought, 4 or 5 months ago. So anyway, it's just a highlight. One of the reasons we do this, of course, when we show these charts, not to focus on the very, very short term, right? We want to encourage investors to think about longer term horizons. Hence the reason why we have the 1 3 month, 6 month, perhaps, and maybe we could argue, Jeff, that we could have even a longer time frame. But of course, that makes the table getting wider and wider. So there you have it.
Yeah, well, you'll see a little bit longer term charts in a moment as we focus on individual segments of the market. So let's look first broadly at the S&P 500. So this is still generally a positive picture. You have market breadth holding up relatively well. Our chief technical strategist, Adam Turnquist, tells me the MACD still says buy. It's still a positive signal, maybe not a strongly positive signal, but generally, the S&P's held on to recent gains. This pullback that we've seen lately has been pretty minimal. So we don't have to talk too much about support levels because we've got to go down quite a bit, to get to the next level. But generally, you've got okay breadth and okay momentum, and we'll just see if we can get through this seasonally weak period in September, which could be choppy. We still got more Federal Reserve risk to work through. We've got some economic data that's a little too strong for the Fed still. Talk about that more in a minute, Jeff. But we could still be in a position to get a year-end rally. It's just probably not going to start right now in our view. Just need to get through a little bit more chop and some of these headline risks before we make that next run. So
you could almost say just a takeaway is it's more of a choppy market, not a bearish market, right? Kind of balancing, as you were saying, the MACD and some of the technical indicators. It's a lot different feel where we sit here in September versus where we were early August in the midst of the sell-off. So choppiness perhaps might be the key word.
100%. So that's where we're at. We think the market's pretty fairly valued. Of course, yields matter a lot to the market right now. You can see that if you just look at the inverse correlation between yields and stock prices. That's this green-red shaded area at the bottom of this chart. So we've moved into a period over the last couple of months where we're seeing some pretty strong inverse correlations. So the stock market does not like higher yields now, which reflect more Fed rate hikes in general. I guess the good news is we're hitting some pretty stiff resistance in the 4.3s. So if we can hold that resistance level, we're below that today. It's of course September 11th, 2023, which I should have mentioned up front. Certainly a somber day, a day where we remember those who lost their lives, and we thank those men and women in uniform for keeping us safe. So while I did not lead with that as I should, that doesn't diminish its importance at all, certainly. So wanted to get that in. So as we're recording this on Monday, you see that we're kind of right up against that 4.3. Actually, 4.33 was the intraday high for yields back in August, and I guess we touched that again recently. Back last year October, and we would touch it again this year in August. So if we can hold that, then you really have kind of an asymmetric outlook potentially for yields, where we could go back down to that 375 level that's our year-end target. And bonds, we didn't gain anything in bonds last week, but we think we're set up for maybe a nice run in bonds over the next several months. But if we don't hold that 434 or 433 on the 10-year, we could be off to the races because there's really not a lot of resistance between there and 450. We don't think we're going to go to 5, but certainly, you have to keep that in the back of your mind as a risk if inflation reaccelerates and we get, maybe a couple more Fed rate hikes coming. So that's a quick look at rates. Let's go through the energy upgrade here. actually in conjunction with the energy upgrade. We actually downgraded consumer staples, and we got a little less optimistic about industrials. Still like industrials, but tempered our enthusiasm a little bit there. So, but let's focus here on energy, because that's the big one. We now like energy more than the industrial sector. It's our top pick right now. And generally, when we make recommendations, we're talking about 9 to 12 months, maybe 6 to 12 months. So this is a chart of crude oil. So, Jeff, maybe you can weigh in on the kind of supply demand outlook here. I guess, again, we're amateur technicians, but looking at this chart, the top chart is just the price of crude up to, 87. This is a breakout, right? Because, you're going above what was previous resistance, through, I guess it's 82.59. And now up 87.74, and it really looks like 95 is next. So if we get oil at 95, and maybe, I don't know if you want to make the case for that, Jeff, but if we get oil at 95, there's further gains ahead, most likely for the energy sector, and certainly the producers are profitable there. So what do you think is there enough demand for crude to push us, into the mid 90s or higher?
I think from both the supply and a demand perspective, you could argue, that the future direction of oil prices is up, either both sides of the equation. But just harken back just a few minutes ago, Jeff, you were talking about upgrading certain sectors, and for our listeners that are LPL advisors, they know about our global portfolio strategy report that's well loved among the advisors, and it explains some of this. But overall, I think the story is, from a supply standpoint, upside pressure, from a demand standpoint, particularly when you think about our own domestic economy. If we do fall in a recession, it's not going to be anywhere near previous recessions or the Great Financial Crisis. And if it's a soft landing, you could argue that that's another reason why the demand side of this will push prices up. So either way, I think from just a price level perspective, there's certainly a good, I wouldn't say necessarily a rosy outlook, but certainly there's reasons why you'd want to have a portfolio that has some exposure to energy.
Yeah, so we're now at an overweight recommendation, and thanks for the GPS plug there, Jeff. The sector's only about 4.5% of the S&P, so that doesn't mean put 20% of your portfolio in energy, but have something north of 5 if you're going to follow our recommendation. At least we think the sector's set up for a pretty solid run here. Not just, we've seen outperformance here recently. I'll show you that in a minute. The performance has been so resilient that the rising dollar hasn't really stopped it, right? Oil is usually inversely correlated to the dollar, but the dollar strength hasn't really slowed it down too much. So this is a chart of the dollar. It looks like a very bullish chart. Certainly if the dollar can break through this resistance in the kind of 104, 105 range, then you're looking at maybe potentially a big run, possibly another 5% higher or more. So the Fed may have something to say about that, but dollar strength is certainly something to watch. The recent performance for the energy sector has been very strong. So, technical analysis is a big part of what we do, Jeff, as you know. And so when you see some of these energy charts, they all look good, whether it's crude oil or it's the energy sector itself. So here you see, I just pulled quarter to date Q3, and you've got energy up 12, plus comm services up almost 6 is in second place, and only financials in the green besides those two, in a market that's generally been flat. So you're seeing good performance out of energy. You're seeing, energy estimates potentially bottom here. That's the orange line on this chart. I'm just showing forward estimates for energy versus forward estimates for the S&P. Remember, we came through that really strong second quarter earnings season where S&P estimates rose as companies were reporting results, which is very rare typically very positive and certainly helped stocks hold their gains. Energy didn't really participate that much. Energy estimates were still coming down, but now we've got rising energy prices and we're seeing estimates tick up, which is good to see. And this is a really cool chart that Tom Shipp from our quant team put together. He and Craig Brown just have some of the coolest charts that I've ever seen. Craig's also on our quant team. This is the total capital return to shareholders for Russell 3000 energy companies, oil and gas producers and integrated producers. And it includes dividends, buybacks, and paying down of debt. Right? I mean, paying down in debt. People don't think of that as returning capital to the shareholders, but it kind of is. You add all those together and just look at this chart. It's just a rocket ship higher, right? So in other words, energy companies, many of you have probably heard that they're not focused as much on production, right? They're more focused on actual profits and being disciplined about their investments and all of that. And that's good. And that allows them to return more capital to shareholders. But there's more to this narrative than that, right? The money that they make, they're using that, which is higher, right? They're producing more cash flows because of the discipline. And then those cash flows are being directed more towards shareholders than ever before. So you're seeing this is basically a tripling since the start of the pandemic in the amount of cash return, capital return to shareholders. So this is a great story, and is another reason why we really like the sector now. There's several positive narratives, but really everything's coming together. They're even reasonably valued still, we think. So all in all, sector just looks really good. With that, let's move on. Soft landing check-in. Jeff, this is your show. So why don't you take over here and try to put into perspective what this recent data means for the economic outlook and what that might mean for markets.
Yeah, I think in this case, it's almost like I'll address the recession conversation like Mohammed El-Erian addressed the Fed's situation just a few weeks ago. He was on an interview basically starting to say, hey, the Fed is too data dependent, kind of making the argument that there are other things going on. I thought that was kind of interesting, but I'll take a slight riff on that, and say, perhaps some investors are too recession focused, meaning, we have in the near term, this idea that, momentum is slowing. The question is, how much will it slow? And then you have in a more longer time frame conversation, well, what are asset prices doing in expectations for what 2024 looks like? And so, yeah, I think it's just so interesting, as our listeners kind of think and hear us say, we're still in that camp that suggests that the momentum is slowing enough, particularly when excess savings dry up and when that credit card bill comes due, consumers will pull back, particularly on services spending, and that'll be such a fairly large driver in the economy to see contraction. But asset prices have moved way beyond that. I think we're starting to. I think it's just another point to just highlight that. But this this story right here is this is just a graph. We blogged on it last week. I won't spend a lot of time on it because I'll highlight the LPLresearch.com website, which is where we blog. So whenever there's comments, you can always reference that, LPLresearch.com. Basically just saying, the orange line there is showing, inflation as indicated by purchasing managers, talking about prices paid, et cetera, have trended down, without question over the last year and a half. But in most recent months, there's a little bit of that concern that, maybe inflation's resurging. Hence, a little bit of choppiness in markets, an increase in rates, pretty much across, the whole curve. But rates, increased as investors thought, well, inflation is going to be sticking around a lot longer. That's the orange line. But if you look at the blue line is basically saying, hey, the services economy is growing. It's the services economy that's supporting overall economic growth right now so far. And here we sit September near the tail end of the third quarter, and wanted to highlight just a couple things. We're going to talk about this in our committee meeting tomorrow, and that is, you have huge variance between Fed models. So Atlanta Fed saying, hey, we could see almost a 6% growth rate in the third quarter. New York Fed saying, no, don't get too excited, 2%. The Cleveland Fed, Jeff, not sure if you're tracking all of this as much as I am. Cleveland Fed is suggesting that Q3 is going to be negative. So it kind of illustrates, I think, in my view, that, coming out of a pandemic, models have been completely torqued. Got to be really careful on how we look at the data. At this point, momentum's slowing. Most investors are kind of saying, hey, well, we'll avoid the outright recession. We're saying not so fast. So that's kind of the main takeaway here from the ISM survey that we got last week. I think, Jeff, do we have another slide on ISM on here? Yeah, as well. Maybe I'll tick this back over to you, because it connects the dots between what businesses are saying about activity. That's the blue line, the ISM index, and then what it means in connecting the dots between what businesses are actually reporting as it relates to earnings. But at this point, we're seeing expectations of that slowdown, and we'll see that as perhaps we go into the latter part of this year and start to see how those earnings will play out for the third quarter.
Yeah, so with earnings, you have to differentiate between, good results, right? Good earnings growth versus better than expected, right? So what we have right now is basically no earnings growth, right? Consensus for Q3 is 0, flat. But that is so much better than most people expected, even just a quarter ago, let alone at the start of the year. A lot of folks were looking at $200 or less in earnings per share from the S&P 500 this year, as recently as, Q2, right? Or certainly, in the spring, Q1. So to get to this point where now 220, 225, a lot of folks are now looking for numbers that good. Consensus is over 220 now, which is really hard to believe, frankly. That's much better than expected, but it's still, I just want to highlight, that is modest. That is no growth year over year, basically. And that is, setting us up maybe for, we think, mid-single digit earnings growth next year. So that really is consistent with, what you see here from the ISM, which is, kind of creeping back to a flat year over year, low 50s, right, Jeff? The kind of a slow growth environment is consistent with what, like a 52, 53?
Yeah, in the very low 50s. It kind of illustrates, this threading the needle that the Fed is trying to do. Hit inflation, get back to that 2% target, which is going to be difficult for that last mile, as we say, and at the same time making sure tighter policy doesn't break anything, and that's where it relates to the real economy, business activity, and earnings potential.
Yep, well said. So I guess with inflation, I'll let you walk through this chart. But we get CPI this week and PPI. So this is probably going to get the most attention of any economic event on the calendar. You had gasoline prices rise, so that will probably elevate the headline CPI a little bit this week, right?
Yeah, and that's exactly right. So that little uptick in the dark blue line is based on expectations that because we had a fairly sizable increase in energy prices, headline CPI, blue line, will have an actual uptick in the year-on-year rate. Month on month, it's going to be pretty hot, 0.5. I think consensus is even a little bit hotter than that, 0.6% month over month. But I think, it's key to remember, and I think investors will focus on this. The Fed talks about core inflation, particularly the inflation metric, not from the CPI report, but from the other sister report from the personal income and spending that we'll get that later in the month of September. And either way you look at it, we'll have a little bit of uptick headline later this week, but we're clearly on the downward trajectory. Look at the orange line. The orange line strips out the volatility from food and energy prices. And so, that's continuing to tick down. And, this forecast that I have here, Jeff, is based on, a 0.2 month-on-month trend, which is pretty conservative. It's possible that as things slow down, particularly in rent prices, we could have something a little bit softer. So if anything, I think there's risk that that orange line right there will tick lower by December than what I even have here in this chart.
So I know you've been talking about a 3.5 kind of core PCE by the end of the year. Is that still a reasonable expectation? Are we thinking that could be lower?
It could even be lower. Yep, the 3.3% I think is where we sit right now by the end of December. The year-on-year rate for the deflator, they call it, from the personal consumption and expenditure report. So it's truly going in the right direction. It hasn't been particularly choppy. We've had a little bit of surprises here and there. In fact, just a couple, I guess, what was it, 2 weeks ago maybe, or last week, we had that surprise on financial services uptick in inflation from insurance. A lot of those were one-offs. So it'll be interesting as we continue to see a little more of those numbers cool off by the end of the year. But again, going back to what I said, I think on the previous slide, we'll hit, a tad higher than 3% inflation in December, but it'll be a little bit tougher to get down to that 2.5% and then 2.3, 2.1. That last mile is going to be real challenging.
Right, but they just need to average around 2. So,
well, that's a great point. You highlight that. That's great for our listeners to remember. That actually came out at the Jackson Hole meeting in 2020. That was virtual. No trips to the Grand Tetons there. No fly fishing. But it's an average over the long term of 2%, which means we were hovering below 2% for several years. Leading up to the 2020 pandemic. So, if you're a little above 2%, you average that out. That certainly is going to argue for the Fed saying, hey, we are finally at the end of our tightening cycle. I think we're getting very close to that point.
And markets should like that, both stocks and bonds. So we'll keep watching the inflation data closely. That's the main event this week. You see here on the economic calendar, we've got CPI on Wednesday, followed by the PPI, wholesale prices, producer price index, on Thursday, and retail sales. I mean, this is a week of pretty important data. I'm going to go out on a limb and say that the Atlanta Fed GDP tracker goes down after this week because it is so hot right now. I just looked this morning, 5.5% Q3 GDP based on the data that's been reported. That just seems totally out of whack with what's going on right now. Is there anything else on here? Well, any comments on retail sales, first of all, Jeff, and then anything else on here that you think people should be thinking about for this week?
Well, I think you can think of the week of inflation being a part one, part two. Part one comes with CPI on the 13th. Part two shouldn't be overlooked. Sometimes it is, and that's the University of Michigan corresponding inflation report. So that's it's not hard data, it's survey data, but I think it's worth putting together. That's why I kind of a 2-part series. Wanted to highlight that, and then in terms of the retail sales report, and our listeners should remember, they probably heard us talk about this before, but retail sales is heavy goods focused. The only services really is restaurant services. Everything else is pretty heavy goods part of the economy. And at this point of the cycle, we're most interested in services, and we're not going to get a good read on that from the retail sales report. But yeah, my key takeaway is for our listeners is it's a heavy inflation week. We're not going to get any Fed speak this week. The Fed committee members are in their so-called blackout period. So that is pretty much the 2 weeks before the September 20th meeting. So at this point, yeah, it's all inflation.
Yeah, and the ECB, which is obviously related to inflation. I believe their meeting is Thursday. I think the market's pretty much split on whether they hike. On the one hand, they have a little bit more of an inflation problem than we do. So that points to a hike. But on the other hand, they have more of an economic weakness problem, especially Germany, than we have. So that points to a pause. So I think those are interesting. When you go into meetings 50-50, that's when you really want to pay attention. So we'll see what happens there. That'll be interesting. And then I mentioned that, the big Apple event this week. I think those are probably the key market drivers. We'll continue to watch yields, oil prices, and the dollar. So anything else you want to highlight, Jeff, that we missed before we close? And you did a good job of promoting some of the stuff we got going on. So
yeah, and just one last thing is, so that meeting on the 20th, the Fed does release its updated summary of economic projections. So that's going to be tightly watched and scrutinized. And so that's worth highlighting as well. So in addition to a statement and a press conference, we'll have a whole deck of papers to go through with that summary of economic projections.
I will close with this. My favorite market news story of the day is the proposed acquisition of Hostess Brands by Smuckers. Because you know what? If I could get jelly inside my Twinkies, I'm going to be a happy camper. So I'll end with that one. Thank you, everybody, for listening. We appreciate. Oh, I actually have one more thing to promote. The Weekly Market Commentary. Sorry, I left this out. Weekly Market Commentary is about the BRICS, right? Brazil, Russia, India, China, plus, which now includes South Africa. So for those of you who have interest in the BRICS, which we actually make the case that they still matter, here you see the GDP for the BRICS is bigger than the U.S. It's north of 35 trillion. Just kind of walking through the outlook for that segment of the world and why it matters. Although the LPL Research team is still cautious on emerging markets broadly, we'd be more active there and try to avoid or mitigate China risk for emerging market investments. So that is our close. So with that, again, thank you for tuning into LPL Market Signals. We really appreciate it. Jeff, thanks for joining and walking through the economic outlook and more. Everybody have a great week, and we will see you next time. Take care.
Take care.